Good morning, ladies and gentlemen, and welcome to the Theiss, the Future of series. My name is Andrea Gritsch, and I have the pleasure of moderating this event. Throughout the series of Future of Events, we are looking at a wide variety of disruptive technologies and innovation in different industry sectors. Together with leading experts in the areas of business, law, and technology, we explore current developments and future trends shaping the markets of tomorrow and influencing modern society. The future of investing is on today's agenda. In the next hour or so, we will hear experts from various backgrounds in law and industry discussing developments and technologies that will influence the investment horizon of the future. Investing today is not the same as it was in 1930 or in 2008 for that matter. The presentations on stock today have a strong focus on the role of technology, including predictions from AI and blockchain-based finance, but they also extend beyond to include sustainability and the possible future of financial institutions as such. The future of investing seems to point more and more towards a direct and customized and, of course, technology-focused approach. Easy investments in diversified asset classes according to individual preferences and bypassing fund managers and, of course, associated fees is already possible. Robo-advisors reduced investment thresholds significantly. Likewise, it becomes easier by the day to attract capital from sources other than classic bank funding. Investment models already now incorporate faster and more data-driven ways to analyze companies, industry sectors, and market trends. While recent global events, including, of course, the pandemic, have shaken up investment markets, we will now look at an even broader topic scale today that will outlast the current environment and continue to shape how and when and where we will invest in years to come. These developments are of equal importance to established market players and much smaller and often narrowly focused niche players. Regulators and lawmakers will, of course, also have to grapple with the impacts of many of the topics our experts will discuss today. Once again, thank you for attending. I hope you find the presentations thought-provoking and informative. Just a few housekeeping points before we kick off today's session. First, each speaker is asked to limit his or her speech to approximately 5 minutes. We will display a virtual timeline counting backwards and indicating when the time is up. Secondly, I would like to kindly ask all participants to hold their questions until our Q&A session at the end of the webinar. You are, of course, invited to submit your questions via our chat function at any time. And finally, everyone, please stay muted when not speaking. Our first speaker of today will be Christina Siegel. Christina Siegel is counsel at Theiss, and she is looking at the main opportunities and challenges for investors regarding sustainability and ESG investments. Christina Siegel is a member of the Theiss Banking and Finance team with a particular focus on regulatory banking law since the early 2000s. Before joining Theiss, Christina worked with the Banking Supervisory Department of the Financial Market Authority, as well as for Raiffeisen Bank. Christina is an expert in the financial sector with exceptional knowledge and practical experience. She has also authored numerous publications. Christina, welcome on stage today.
Thank you very much for this introduction. Yes, I would say currently sustainability is one of the hottest topics in the world. And nevertheless, financial returns are, of course, still key to investors, but sustainability impact has become a core part for investment decisions. But why is this so seen as a current trend? On the one hand, of course, awareness of ESG issues has increased. In addition, increase in access to ESG information and data to funds which have ESG goals embedded in their strategies, as well as companies who have started to incorporate ESG credentials into their processes and corporate actions. On the other hand, in particular, initiatives like, for instance, the Green Deal also have led to an increase, in particular when it comes to green bonds and like this. For instance, just this week, the EU Commission has published that it tends to issue 250 billion of green bonds within its project Next Generation EU, which would mean that EU Commission would be the biggest green bonds issuer ever. The EU Green Bond Next Generation EU is one of the projects in order to finance and mitigate the risk of recovery, the risk of the COVID-19 pandemic. In addition, also Austria intends to issue a green bond for the first time in the first half year of 2021, and Germany has issued its first bond already in the first half of this year. However, what is the main key issue here? We talk about sustainability, and what does this mean? One issue is in order to define sustainability. When it comes to sustainable finance, usually it's defined as environmental, social, and governance considerations taken into account when making investment decisions in the financial sector, leading to more long-term investments in sustainable economic activities and projects. The risks and challenges for investors in this regard is in order to measure what is sustainability and ESG, because it's very difficult to measure such topics, in particular because of the fact that ESG goals are based on potential for long-term impact, and it's difficult to measure success in short term. In addition, of course, it's clear that there's also ongoing greenwashing, or at least alleged greenwashing. In order to mitigate this risk, the EU Commission has undertaken three main measures. First and foremost, the EU Commission has published the EU Taxonomy Regulation, which has established a framework to facilitate sustainable investments, which applies to the financial market participants. Second, there is EU Disclosure Regulation on sustainability-related disclosures in the financial sector. And third, the EU Commission has published in July 2021 the proposal for an EU green bond standard. This green bond standard is open to all green bond investors, issuers, not only within the EU but also outside of the EU, and forces four key requirements. First, the funds raised should be allocated fully to projects aligned with the EU taxonomy. Second, there must be full transparency on how bond proceeds are allocated through detailed reporting requirements. Third, all EU green bonds must be checked by an external reviewer who has to be registered and supervised by the European Securities Markets Authority. So, when it comes to green bonds, there are many initiatives on an EU level to ensure that there is to ensure quality and reporting requirements. In case of ESG-linked bonds, it's rather the ESG rating which is decisive to ensure the quality of such instrument. Apart from this, in case of direct investments, like for instance from private equity funds or hedge funds, or even in green financial technologies and green FinTechs, it's the due diligence to be carried out. Apart from this, when it comes to retail clients, it's in particular UCITS funds which have some sort of sustainability labeling. And in this regard, also initiatives on an EU Commission level have taken place in order to ensure that investment advisors have to take into account sustainability criteria within their investment advice. Summarizing, one could say that it's not dependent on the type of investment, but rather how the investment is to be made. So from the type of investment, every type of investment could be structured in some sort of sustainability or green labeling. But one could say the principle is substance over form. Thanks so much.
Thank you, Christina. I think it's safe to say that sustainability is the buzzword of the hour, and for sure also impacting our next presentation, which is to be given by Markus Klug, member of the executive board of Bundespensionskasse. Markus Klug will be addressing the question of how pension funds will navigate the investing challenges of the future. Markus started his professional career at Reuters and joined Kreditanstalt Investment Bank in Vienna and Warsaw. He further worked at Barclays Capital in London before returning to Vienna, running Unica Alternative Investments for several years. In 2008, he was appointed to the Executive Board of Directors of Bundespensionskasse. For 13 years, Markus Klug was also a lecturer at the Institute of Banking and Finance at the University of Economics and Business in Vienna. Markus, the stage is yours.
Thank you. Thank you very much. Good morning, everyone. As we heard from Mrs. Siegel, there's an awful lot of regulation hitting the desks of institutional investors like pension funds and insurance companies. And if you look at what is out there in terms of how those companies formulate their ESG concept, you find it's often not very comprehensive. It is mainly driven by investments in equity funds. So what can be done with publicly listed equities? And it's very, very unclear in terms of the target setting most institutions have. So to give an example how we went about it in terms of implementing those types of legal standards, be it a disclosure policy or be it the EU taxonomy and all the other bits and pieces we are facing from the regulators and from the European Commission and national law. We first set targets. Setting targets is the foremost important step. So we set ourselves a temperature target we want to achieve at a certain point of time. In our case, it was 1.5 degrees by the year 2030. So that's quite an ambitious target, we feel. And we also set the target that we want to achieve a net zero status with our portfolio by the year 2040, which is actually also in line with the Austrian government's initiatives. And that's the setup for our ESG policy, which covers each and every asset class within our portfolio, and our portfolio ranges from equities to bonds to real estate to renewable energy to forestry, loans, other forms of debt. So we pretty much have all kinds of investment products within our portfolio. And with the totality of those products, we have to achieve those targets. The other important point is, how do you implement those targets? How do you go about it? And as Mrs. Siegel has also alluded, avoiding greenwashing is a very important item here. So you have to think very hard what constitutes greenwashing from your perspective, but also from a regulatory perspective. That might change over time, to be honest. But it's foremost to avoid greenwashing type of communication or greenwashing type of limits or communication in your portfolio. The other one is engagement. So you have to consider what sort of engagement you want to achieve. Do you want to engage with corporates directly? Do you want to engage indirectly via asset managers? Do you want to engage with investor initiatives, which are also ramping up their membership, and you can exchange views and exchange information with like-minded investors, or do you want to do it in a different way? And the last thing I would mention is stakeholder reporting. So you have to consider what you actually want to communicate to your stakeholders and how. And this is like in a reverse order. When you set up the limits, and once you define what you want to communicate with your shareholders or stakeholders, that implies also what you have to do, can do on a portfolio construction process or a portfolio management process. Maybe not most, but a lot of institutions and some industry participants consider ESG still as a risk management tool. which is only part of the equation. Yes, it's correct. It's ESG is a risk to those institutions, but it's also at the same time a tremendous investment opportunity. That's something we should not forget. I mean, that's the biggest point for us, is that especially in a low interest rate environment where bonds, either corporates or government bonds, do not provide any significant yield to achieve your payments on the liability side, and interest income is has almost been. It's very important to diversify into other asset classes, and ESG and the taxonomy, especially with its focus on green finance, provides a tremendous opportunity to diversify away from government bonds and corporate bonds into other asset classes, which help to achieve the transition to a green economy or to a net zero economy. And this is not only applicable to equities, where it's easier than in other asset classes, but it's especially applicable to energy, renewable energy, to commodities, to private equity, to venture capital. So there's a lot of other asset classes you can consider making an impact, not only making an impact, but also achieving financial returns within those asset classes. I'm not sure how much time I have left, to be honest. But,
please go on. No, finish the thought.
Good, thank you. So that's, I think, the foremost issue, that it's not to be considered purely as a risk. I mean, there are all sorts of problems in terms of reporting, which you're perfectly aware of that. One is basically the scope-free CO2 emissions, which is still, to be developed, as the data currently is fairly poor. So obviously, with the target set, you also have to include scope-free, which will improve over time. There are other data issues you have with the less liquid asset classes or real assets. So it's also an exercise of finding that data and developing those models further. But that can only be set, or that can only be achieved once you have defined your targets. And if you look at some very large asset management companies or some large insurance companies or pension fund companies, normally they have a sort of investment policy which covers ESG. But if you try to nail it down into actual targets, which you can also monitor or see how they progress on those targets, it becomes very difficult to see that, and because most of those targets are soft targets and not hard targets. That is probably a result of their decision what they want to report to their stakeholders. But I think it's a lack of focus on their investment policy, because it does not give the portfolio managers a clear yardstick what to look for and how to go about those investments. And some of those targets are very long-term targets. But you're dealing with illiquid asset classes like real estate or private equity or venture capital. Therefore, decisions you make today, you will see those results in 5, 6, 10 years' time. So it's very important to get it right in the first place before you invest in those types of long-term asset classes. I think that's one of the key learnings, at least from for our company. Thank you.
Thank you, Markus. And for sure, devil is in the detail here. While
Absolutely.
you are representing the heavyweight, so to say, our next speaker, Niklas Schmidt, partner at Theiss, is looking towards the other end of the scale, namely, will decentralized finance replace financial institutions? Niklas Schmidt is both a lawyer and a tax advisor in Theiss. Before joining the firm, Niklas worked for several years at a Big Four accounting firm and as a research assistant in the tax law department at the University of Vienna. Niklas is frequently engaged as a speaker at international tax conferences and has been a visiting lecturer at various universities in Austria and abroad. Currently, Niklas is a member of the advisory board of the Digital Asset Association Austria. And he has particular love for crypto assets and blockchains, has written numerous books on these topics, and regularly lectures on crypto assets, also within the Wolf Theiss Crypto Academy. Niklas, the stage is yours.
Super. Thank you very much, Andrea, for the kind invitation to speak here. The topic, will DeFi replace financial institutions, is a bit of a crystal ball topic. And I have 5 minutes, although I actually need 5 hours to explain what DeFi is, how it works, before we could then actually move to answering the question. But I will nevertheless try to do the exercise in this very compressed time frame of 5 minutes. So what is decentralized finance, or DeFi? So basically, currently we have centralized finance. This is what predominantly happens. So financial services being sort of offered through central actors, through banks, through insurance companies, through investment funds, derivatives, desks, and so on. So financial services being offered by counterparties. And the idea is, let's replace these counterparties. Let's replace these intermediaries by smart contracts. Smart contracts are computer programs running on blockchains, such as the Ethereum blockchain, running basically on autopilot, running in exactly the manner that they are ought to run. So decentralized finance is, in a certain sense, very experimental. It's a very young phenomenon. It started more or less in March of 2020, when lots of people were grounded, sitting at home, had a lot of time and a lot of opportunity to look up what is happening in this DeFi space. On the other hand, it's maybe not any more experimental. There's a lot of money locked in smart contracts. The correct metric here is total value locked. And currently $90 billion are locked in smart contracts that belong to this decentralized finance ecosystem. I mean, $90 billion is, of course, nothing if you look at the values that the world of finance normally operates with. But if you look at the curve, at the progression of this total value locked metric, basically things have been happening extremely fast in an extremely exponential manner. So decentralized finance, why do we need it? What are the pros? What are the cons? So basically, the pro, I mentioned already, you get rid of an intermediary. So you're not at the mercy of your counterparty's solvency, basically a sort of business ethics. You're not at risk of something bad happening. You get rid of the intermediary and you replace the intermediary, as I mentioned earlier, with a computer program. And this has a number of ramifications. Basically, if you open a bank account, you have to fill out 20 pages of forms, lots of regulatory stuff, AML, KYC, FATCA, Common Reporting Standard, and so on. You need permission. So basically, you cannot get a bank account. There's no right to a bank account, as far as I understand, at least not in practice. You have to sort of get the other party's permission. If you take out a loan, that is very clear. You need a permission that you are sort of seen as trustworthy to be paid out the loan. So there are lots of things here, and all of this we get rid of. Yeah. So with decentralized finance, you can open bank accounts in a certain sense 24/7 from around the world. You don't have to fill in forms. You don't need anybody's approval, and you don't actually have to identify yourself. You don't have to go through KYC and AML. What are the disadvantages? Well, okay, we replaced the intermediary, we replaced the counterparty, the corporation, the bank, the insurance company, and so on. Replaced that by a smart contract. And what we're doing is we're replacing one type of trust by another type of trust. So now we have to trust the smart contract. And bad things can happen here. They have happened from time to time in this DeFi space. But as things get more mature, maybe these things will also get better. Now, what are the sort of most famous, most important offerings in the DeFi space that you should know of if you have never heard of DeFi before? Well, first of all, there are these platforms which operate like banks. So you can put in money, you can deposit money, and when you deposit money on these platforms, money means basically crypto assets. And if you're thinking that crypto assets are like really volatile things which go up and down, okay, that was yesterday. Basically, if you think about Bitcoin's price going up and down, But in the meantime, you have certain crypto assets which are stable in value, so-called stable coins, crypto assets pegged to a fiat currency, for example, pegged to the US dollar. And basically on these platforms such as Compound or Aave, you can lend money, you can deposit money, and you get paid interest on your deposit. The interest rate is interesting because it changes every 15 seconds. So on the Ethereum blockchain, where Compound and Aave operate, they also operate on other blockchains, but that's for another session. So on the Ethereum blockchain, the block time is 15 seconds. So every 15 seconds, you get interest on your deposit. And why would you actually use these platforms? Of course, there are some crypto people who are full in the world of crypto. They hold Bitcoin. They have long-term holding plans. They're hodlers. And Bitcoin is basically like gold. It does not generate any yield. If you have a gold bar in your bank deposit box, it will not pay any interest. That's just there. The same is true with Bitcoin. If you hold Bitcoin, Bitcoin is not a stock where you get dividends, or it's not a bond where you get interest payments. But on these platforms, you can basically also deposit Bitcoin and make Bitcoin into an interest-bearing asset. That is maybe more for the crypto people. But for the ordinary people, let's put it this way, for the ordinary people, such platforms as Compound and Aave actually make something possible, which is quite incredible. As you know, we're in a low interest rate environment, so you will probably get 0.0001% on your bank account. And what some people are doing, and apparently the numbers are growing and show this, sort of basically taking money from their bank account, converting that into stable coins like USDC, USD coin, or DAI or others, Tether maybe, and depositing these stable coins on such platforms. I looked it up today. You get basically 4.2% interest rate on DAI deposits on the Aave platform, and 4.8%, something like this, for USDC on the Fulcrum platform. So it's orders of magnitude higher. Of course, higher yield is always due to higher risk, and there is, as I mentioned, always the smart contract risk. But these things have been running in the meantime for quite some time. I mean, quite some time, okay, 1.5 years. Some of the platforms a bit longer. So it seems as if they were quite safe. And it seems as if also, and I'll mention that later, quite some professional, larger investors are making use of these platforms, which is a reassuring thought. So the interesting thing with these computer programs is you can put them together. You can do what is called money Lego. So if you have a bin of Lego pieces, you can basically put them together in arbitrary order, create totally new stuff. And the interesting thing here with these smart contracts on decentralized finance is you can also mix and match various of these products. You can do lots of automated stuff, and the opportunities are basically endless. Everything we have in the world of finance is just now, as we speak, being replicated in the area of decentralized finance. So we have the banks, I mentioned them. We have exchanges, so crypto exchanges are being copied, basically, or they have been copied. They're called DEXs, decentralized exchanges. Uniswap is a very famous example, and they use a certain mechanism called automated market makers, and they are always in a position to provide liquidity for your trades. So basically, if you want to swap DAI against ETH, you send the DAI to the smart contract and get ETH back. If you send ETH to the smart contract, you get the DAI back. There is no risk involved. Basically, if you hold your crypto assets on a centralized exchange operated by ABC Corporation, you always have to trust this corporation. You always have to trust them because they are holding your assets. And here, in this world of decentralized finance, with these decentralized exchanges, basically nobody's holding your assets. They're locked in a computer program, in a smart contract. And then you have insurance contracts. In the meantime, if you're afraid that some of these products where you're putting your money in, if you're afraid that they will sort of go bust, that there's some bug in the program, in the computer code, then you can take out insurance against smart contract failure. So the funny thing is, this insurance is also available, or is actually nearly only available, exclusively available in the form of smart contracts. So you have DeFi apps offering smart contract insurance. You have derivatives, so you can buy all sorts of synthetic products. You have investment funds, and you have the possibility to do something which is really funny, namely to stream money. All of you have probably been streaming videos, but you can now also stream money. You can send incremental tiny amounts of money per second, per minute, per hour, whatever. I'm slowly coming to an end, and I'm going to now answer the question that was posed to me. So sorry for the long road to this solution. So will DeFi replace financial institutions? What does my crystal ball say? Well, I think DeFi will not replace financial institutions. There will be a bit of convergence, and we are seeing it from both sides. On the one side, DeFi is moving towards the financial institutions. DeFi is trying to get financial institutions on board to use their platforms. So, for example, Aave has recently launched Aave Pro, which explicitly addresses, or which explicitly has as its sort of potential customer base large banks that want to sort of invest their liquidity there. There was also just a day ago a report by Chainalysis, which is the leading blockchain analysis company, and this report said that in the second quarter of 2021, large institutional transactions made up 60% of DeFi transactions. And large means basically transactions with $10 million or more. So we are seeing of course, there are the retail people, small guys like myself, trying this out. But there's in the meantime, there's also sort of serious money involved, and people who manage other people's assets, trusting DeFi protocols. So this is the one movement of convergence. The other is what I see like on the horizon, financial institutions moving to DeFi. And of course, this is a market economy, yeah? You have to offer something attractive. You cannot offer 0.00001% interest rate if you get an interest rate of 4 point whatever percent in this DeFi space. Of course, taking into account risk, you probably will have to make a bit of a deduction from this interest rate, but nevertheless, the DeFi rates are a lot more attractive than what banks can offer. So probably we will see at some point in the future the traditional banks opening up a window into the DeFi space. So you might be able at some point in time to use your mobile banking application. And as you currently have the possibility to basically view your bank accounts, your securities deposits, your credit card statements, whatever, you will probably also have an entry with Aave or Compound, where you basically say, okay, I'm going to shift money from this to that asset class. So that is it, and thank you again for the invitation. Back to you, Andrea.
Thanks, Niklas. I believe that's an interesting thought of actually bank customers depositing their life savings at less than 1% and banks parking liquidity at more than 4%. So certainly worth exploring in further detail. Our next speaker comes from the same area. Florian Wimmer, CEO of Blockbit. Your presentation has the very catchy title, Will the Tax Authorities Hunt Me Down If I Do Not Declare My Crypto Income? Florian Wimmer finished his technical diploma at the University of Applied Sciences in Austria and worked over 4 years for KPMG. The combination of technical and economic know-how paired with his early interest in cryptocurrencies and blockchain led him to co-found Blockbit in 2017. Blockbit is a regtech company developing compliance software to tackle the issues of complex taxation and money laundering when it comes to blockchain-based assets. Florian, we're very excited to have you today.
Thank you, Andrea. Since Niklas took his time with the presentation, I'm going to make this one short. The answer is yes. Thank you very much for the attention. No, I'm just joking. Not on the yes part, but let me go a little bit into why and how can they do this. As Niklas already said, there is no need for KYC or registration in DeFi, right? But it is a false assumption that crypto is anonymous. And I'm also going to elaborate a little bit on the whole centralized finance versus decentralized finance. So on the one hand, we're having financial institutions that are offering services to users who want to invest into the crypto market. And those, of course, are regulated. So you have to do your KYC there. You have to do some form of identification. They are all now under the anti-money laundering directive with the latest version, which also tackles down on the virtual asset service providers. So here I'm not anonymous, and there's a new regulation coming out that also targets the tax space and tax regulation, which is called DAC 8, which is the directive on administrative cooperation, and will also include crypto assets. So all those regulated financial service providers will have to do automated transaction data transfer to the authorities, meaning sending everything they know about you and your trading activity on those platforms to the respective authorities, making it possible for them, of course, based on that data, to calculate exactly which gains you realized in which tax category they will fall and how your tax liabilities are, and then comparing that to your income tax statement of the last year. On the decentralized side, we're having it a little bit different. So it's not anonymous, but most blockchains, I'd say 99% or more, are pseudonymous, which means you don't really know who is the person behind the account, but you know that account A sent that much money or whatever, or indexed with the smart contract at that time to person B or to himself. So once we can actually put a person or an entity behind this address that you can imagine like an IBAN in the banking system right now, it is absolutely possible and even easier to trace down than it is on the centralized exchanges, because blockchains are immutable, they are transparent. So I can, like, from the existence of blockchain, from the very first data that got in there, read out everything that happened until this day today. And the combination of having those centralized data and decentralized data is basically making it more transparent than ever. So I have to do my first step into crypto via my fiat money, right? So I have to transfer it from a bank account to a regulated exchange, transfer it to Bitcoin, Ethereum, whatever. And then I can jump into the DeFi space with a few examples like OTC trading and so on. But for most of the people, it's going to be this way. And there's also a second regulatory directive coming out on an EU Commission basis, which is the De-Anonymization of Wallets, which means that those financial service providers not only have to transfer the data that you or the transaction that you did on their platform to the authorities, but they also have to transfer data on all those public keys and wallets that you're using to deposit and withdraw from the exchange linked to your persona to those financial authorities, which in an ideal case paints them a complete picture of everything you did when you set your first step into Bitcoin or other crypto assets. And we're having a lot of tax liabilities that incurred on crypto. So we actually did a study last year with the Frankfurt School of Business, calculating the taxable liabilities for crypto in 2020. And we've been at 3.2 billion for Germany and 375 million in Austria that would have to be declared as taxable income. Probably going to be a lot higher number in 2021 when you're looking at the crypto market. So of course the authorities are going to want their piece of the pie here, especially in times like we're having right now, where every euro counts. But it is definitely not an ideal solution. A lot of stuff is happening on the tech side, and it's really hard for regulators to catch up. There are first steps taken with those two directives coming out. But of course, technological advance is really fast, and this is always going to be an ongoing race of people trying to abuse the technology to tax evade and authorities trying to catch those tax fraudsters. But when you're talking about the general public and the most part of people accessing those services that are not that tech-affine, they have to use some centralized gateway, and this is where it makes it basically possible to track down everything you're doing afterwards. Thank you.
Thanks. That was very enlightening. In relation to the trend that you are describing, I believe that also fits very well our next speaker, Richard Clegg, partner at Theiss. Richard, you will be speaking about whether or not there is an upcoming stock market bubble and will it burst. Richard is a TMT lawyer working throughout Central and Eastern Europe and Southeastern Europe. He has particular specialization and expertise in infrastructure, telecom, energy, and technology transactions. Richard has held senior positions in industry and private equity as an M&A partner with an industrial and infrastructure fund and as the Group General Counsel and Group Investment Director of Bulgarian Telecom. Richard, the stage is yours.
Super. Thank you, Andrea. Taking investment advice from a lawyer probably leads you to quite a cautious investment portfolio. But I think, broadly, the question, is there a stock market bubble and so will it burst? Of course, the starting point is there a bubble? And when we look at CNN and Bloomberg, and typically we're following these of US, and the S&P 100 is up, 300% in the last 10 years. I think we're 14 sort of consecutive weeks where we have a sort of new high. But if you look more broadly than that, it's a bit more nuanced. So in the same year period, Russia, over a 10-year period, the Russia index is up 100%, India 200%. Even the UK mid-cap, with all of the Brexit issues, is 130%. But today, of course, we're talking from sort of Central Eastern Europe. And if you look at the iShares CEE index, that's only up barely 10% over the last 10 years. So it's been a very flat situation for CEE stocks over that period. Now, Theiss is obviously a sort of law firm. And as a result, I guess we are looking more, and our sort of professional work is more upon what would typically be called value indicators. So in our business, we see sort of supply chain issues, foreign direct investment, M&A, labor issues. And on that front, currently, as you might expect me to say, there's certain positive indicators and certain negative indicators. I think from a positive side, we obviously see an increase in sort of manufacturing production, particularly after the sort of COVID year of 2020. And looking at the current data, for example, in the Czech Republic, we see the industrial production up almost 8% from last year. Factory output has increased steadily throughout 2021, despite the supply chain issues. In Poland, the purchasing managers index, which gives you a view as to how positive the purchasing is for larger companies, has been comfortably above 50%, so in positive growth territory throughout this year. And fixed investment, so investment into capex, is also for Poland is also going to be around about 7%-ish for this year. On an internal view for Theiss, I'd say we also see a very positive picture. We see a lot of foreign direct investment into the region, and that's been a trend throughout actually the end of the Trump presidency. So some of the trade war issues, I think, actually benefited CEE, and we saw production coming back from Asia into Eastern Europe. We also have seen a lot of M&A activity, and not only from larger industrial private equity, but also quite interestingly from the US. So particularly since the start of the Biden era, we've seen a lot of US venture capital coming into Central Eastern Europe, which is extremely positive. And when we say venture capital, that doesn't necessarily mean small investments. I mean, now a venture capital Series C, D can be well over 100 million euros. So that's very positive. And I think the last positive value signal is also people coming back to the region. So obviously from the changes in 1989, there was this brain drain out from Central Eastern Europe into other countries, maybe triggered by COVID, but more generally because of the opportunities now. We see people coming back from the UK, from Germany, opening up businesses. And I think that's a very positive sort of value indicator as to how the companies are sort of doing. Of course, for every positive, there's a negative. And, I mentioned the figures, but they have been slipping since the end of the first quarter. Inflation, I think we're all aware, is clearly being felt, not only for consumers when it comes to food, but also for the companies. for sort of commercial supplies and raw materials. And clearly that's sort of squeezing prices and therefore sort of reducing returns to shareholders, which sort of theoretically should be pushing down shares or prices. And whilst overall European GDP is up, I think for the second quarter of this year, we're up 2 or 3% from the beginning, the Eurozone as a whole is still below its heights in sort of 2019. And that compares unfavorably to the US and to Asia, which have exceeded those sort of 2019 highs. So Europe, is seeing different aspects. We generally, as a region, I don't think really solved the issues from the 2008 Greek sort of Euro crisis. Obviously, Brexit has had some impact on that. And I think, we are sort of slightly behind the curve. But all those things are sort of value indicators when you're looking at a sort of company and locals of manufacturing. But when, of course, we talk about stock market valuations, there's a big macro picture. And I think that clearly the sort of story for the last 10 years, particularly for the US, Europe, has been the money supply. The Fed has been sort of supporting through the bond purchases similar to the ECB. Whilst we're talking today, it's the latest ECB monetary policy meeting. Tapering is on the agenda, meaning to try and sort of reduce the money supply. But I think on balance, it's much more likely that we're going to see the money supply sort of continue at a very high pace. If you look at, for example, for the sort of Japanese economy, which has had a sort of money supply for the last 20 years, in a sort of Japan, the sort of Japanese central bank currently holds over 50% of government bonds. And its debt to GDP, private and government, exceeds 400%. In the States, the Fed owns about 25% government bonds and debt to GDP is only 250-ish%. So there's a long way to go. And if you think of that, of those debt levels, reducing money supply would increase interest rates. And I think it's very difficult for any government to really impose that upon the country, upon companies. In Europe, of course, we also now have the COVID relief programs, and every member state submitted its own proposals for the infrastructure spending. My own view is that infrastructure now will not mean roads and bridges, but rather lots of that spending will go on 5G, green initiatives, AI, all of which is very positive when it comes to this growth of stocks. And I think combined with a slightly better as a demographic picture for the region than we've had for so many years, people coming back, people staying. To answer the question, personally, I don't think that we're either in a bubble for the region, and I also think that we've got several years to go, keeping quite a cautious eye on the exit as always. Thank you very much.
Thanks very much, Richard. This is sort of the perfect setting also for our next speaker, Emmanuel Salinger, professor at Technical University of Vienna, looking into his crystal ball and determining whether AI can give serious predictions on future market trends. Emmanuel Salinger is a professor at Technical University Vienna and as such head of the Knowledge Graph Lab and member of the Databases and AI group. He's also senior research collaborator at the University of Oxford and has been directing the value-added data lab for many years. He and his team are particularly focusing on the finance sector, researching and building financial knowledge graphs for various applications. Recent research topics, I believe, include AML and compliance, analyzing company ownership and control, building financial enterprise knowledge, and controlling the financial effects of the COVID crisis. Emmanuel, here is your audience.
Thank you very much, and also thank you to all previous speakers, because we basically put together a series of topics where we could all talk now about where AI is predicting market trends in each of those parts. And we could now pick, well, we have heard about sustainability, supply chains, M&A, KYC, anti-money laundering, and so on. And for each of those, we could now think about the storyline of how AI influences this and where it doesn't influence that. Since some of you are on the regulatory side, others are on the making investment decision side, let me actually start a bit on the regulatory side with a concrete problem to get us started there. And that is basically roughly 1.5, 2 years ago. Well, you can figure out what time that was. There was a particularly crisis starting and a very concrete problem that, well, that's a project that we did together with the Central Bank of Italy and Oxford University that we were tasked to look at, namely, well, we had a big crisis, well, COVID was starting, and there was the danger of market trends allowing hostile takeovers of strategic companies. So there was a big danger of, well, investments being made for purposes that would have very dangerous implications for many of us and many countries' economies. And, well, how do we go building an AI system that can predict some of the market trends? How far does AI go? We all know about the hype. AI is supposed to solve everything. Well, we know that in some cases, yes, it changes everything. In other cases, well, it's just as usual. Humans make decisions and sometimes make them better than machines. So how do we actually balance those topics? So let me go through 3 points. We just have 5 minutes. So let me just go through 3 points of touching a bit of the basics, what it means bringing AI into such topics and how this is made. So let me actually start with, especially given the topics we discussed before, with one major topic on which kind of AI should be used. So by now, probably most of you will have heard that, well, there are many AI methods out there that allow you to detect patterns in data. So one of the big effects of AI methods in all of these topics for predicting market trends is, of course, well, looking for particular patterns and learning systems that, training systems that can detect them and doing that much faster than a human ever could. And you can imagine in all of these topics, including, well, detecting hostile takeovers or sustainability or decentralized finance, this is very important to detect these patterns. But one topic that we have seen now, mentioned by many of you before, is actually the importance of knowledge that is in there, knowledge about regulations, knowledge about laws, knowledge about, well, things that one of the human investors or human regulators knows, but it's very hard to transfer to an AI. And that's the second type of AI that very often we build into such systems, and that is knowledge-based AI. So we have this data-based AI that allows us to very quickly detect patterns, fast, very well. And then we have this knowledge-based AI, which is very much about understanding laws, depending on your area. I mean, for example, learning the Basel III regulation is probably not the best type of AI to find, but it would be very good if your AI system knew the Basel III regulations, if you're in that type of, under that type of regulations, and so on. And that's the first point I wanted to make, and that is figure out in this particular type of market where you're trying to predict trends, which type of AI is needed and how to bring it together. And that's also one of the holy grails of current research on AI and finance, is bringing together this data and knowledge-driven AI methods. We could talk about that for hours. We won't. Let us go to the second topic. And since we are running out of time, just a very quick note on that. And that is know your data. And the second point is that we have a lot of lagging indicators these days, lagging indicators like a lot of past finance data and reports and so on. But as you all know, a lot of leading indicators are out there right now. News reports about companies, different kinds of hiring patterns and so on. So real-time information that, well, some AI systems actually take into account, but it's really important to get the right mix together. The mix of the typical lagging indicators in terms of, reporting and past financial data, but also an area where a lot of companies are actually in right now, namely news analysis and hiring pattern analysis and so on. So all of these external signals that are sometimes ignored there, and getting the right mix there. And the last point, since I'm actually already out of time, is how to bring this together. And well, deliberately didn't put it as the first one, because one of them, you see the term knowledge graphs now thrown in here. Knowledge graphs, you may know from whenever you do a Google search and you get information displayed from knowledge graphs. But what many financial companies these days are doing is bringing order into this whole chaos of AI through systems that bring all of these AI methods together in a system where they can actually ask questions and get transparent answers. And that's why so many companies these days are looking at knowledge graphs to build all of their market information, AI methods, internal information together to expose as one transparent AI system. And I think these are the main 3 points to take into account here: which type of AI, which data, and how to make all of this work together inside of systems like all big companies are using out there, Google and so on. And the main thing there is, today, this is not just something that the Googles and the Facebooks of the world can do and the biggest financial companies. This is something that really is being used actively by many companies out there, and that is not so hard to use for many of us. And actually, now going back, closing the loop to the topic that we started with, namely, well, can we predict hostile takeovers of companies? And well, by combining many of those methods, well, that's certainly possible. So there are ways of predicting such market trends. But one important note, and that's something that I usually stop such talks with, is it's also important to know the limitations and things where humans make good decisions and where it's possibly good if your AI system has access to that human's knowledge and ways of making sure that some of the ethical considerations, sustainability considerations, and so on are taken into account. And we all have the technology right now, and many of universities and companies are developing it. It's just that we need to bring it together in such ways as to make such AI predictions. So my answer to the question is, of course, like many of the answers before, yeah, well, yes, but with certain conditions. So with that, that's all we can cover in 5 minutes. Thank you very much, and I'm looking forward to your questions later on.
Many thanks, Emanuel. And the yes, but it depends sentence, that's reserved for lawyers. But in any case, I take away the brilliant thought of bringing order into chaos. That's certainly something to mind. Last but not least, we have now on stage Michael Kienzl, Senior Associate at Theiss, talking about what kind of impact finfluencers can have on the investment community, and is regulation indeed needed? Michael has expertise in a wide range of industry sectors, including financial institutions and TMT. Before joining our firm, he spent 15 years in the financial sector as an investment banker and asset manager. He worked at several international investment banks in product development and trading. Michael also holds a degree in engineering and aviation technology, economics, and of course, law. Michael, we're happy to have you today.
Thank you very much, Andrea, for this kind introduction. Obviously, I'm that old, and if I would have met Emanuel 20 years ago, my life would have been much easier. Anyway, hi audience. Thank you for still being online and joining me on my quick journey through 25 years on Wall Street and the lessons I have learned leading to the question, like Andrea said, what kind of impact can finfluencers have on the investment community, and is regulation needed? Back then, as I started as a floor trader in 1996 in New York, the markets basically were driven by professionals and institutional investors like brokers, investment banks, hedge funds. And this crowd was linked more or less via some kind of intranet, so a closed group. With the hyper success of internet and the upcoming of discount and the internet trading platforms, the hurdles of being an investor were lowered dramatically, and a new flow of capital driven basically by psychology became part of trading, which at that time was good and bad at the same moment. Anyhow, the liberalization of information and investment possibilities brought a fast-growing group of unprofessional, unexperienced individual investors to the financial markets. Other than us, the professional investors, with our internal risk management regimes and, like we heard today, tons of compliance obligations, this crowd wasn't interested in things like fair value of an underlying or discounted cash flow evaluations. They just want to get rich immediately. And consequently, and that's also what we heard today in some of the speeches, the volatility went up dramatically in relation to the 90s and times before. And I don't think that this kind of volatility level, or an average volatility, will ever go down back again. So at this point, and it was somewhere around 2001, I realized that capital market sentiment is a really relevant driving and timing factor. And the relevance increased even with more individual investors participated in market activities. So based on that findings, and I did also an own algorithm on this, but some smarter colleagues of mine, they started building a system that sustainably collects and evaluates the sentiment of now more than 4 million professional market participants and derives decision trees from it. In the meantime, something like a collective intelligence has developed from this, with the possibility to predict the future behavior of at least professional investors. And like we heard also today, making money on stock exchange or Bitcoins or whatever, you need to have a position, and this position needs to turn out to be the right one. So we're getting back now to our crowd of individual investors, meanwhile more like a giant swarm, with access to unlimited possibilities of the capital markets. And what could these mostly unexperienced and unqualified investors looking for? It's guidance. Guidance by media, by professionals, by influencers. I would call all of them kind of gurus. So with the new media offers the opportunity to bring information direct to the peer group and shorten the decision-making process dramatically. And as a result of this, a lot of people acting simultaneously and moving in one direction. And this movement in one direction creates a huge sentiment. This gives other people, let's call them, for instance, Elon, or institutions, maybe we call them Reddit, the opportunity to generate a specific long or short sentiment whenever they like. In the 90s, when I had to learn rules and regulations, this was called front running. So should this wonderful new investment universe driven by sentiment be regulated? As a lawyer, and depending on the client we are working for, I would say it depends. In any case, it results in difficult questions of differentiation. Questions like, could a finfluencer be classified as an expert, and thus, at least in Austria, liability as an expert would be possible? Is the finfluencer providing advice or just information? Is there a need for registration with authorities like FMA or SEC to prove at least some kind of knowledge? Anyhow, if a group of homogeneous persons, and that's the real relevant part, acts in mutual agreement and without the need for kind of a guru, there is, from my point of view, no imminent need for regulation, even if this crowd is or can move a whole market. Bottom line, getting back to the topic, bottom line is that capital market regulations should protect, in my view, the weaker part and equalize knowledge asymmetries. With social networks and crypto assets, the whole system became more decentralized, faster, and many times more complex. whether and how this organism could be regulated in the future is not really accessible at the moment, and there are huge varieties thinkable, but this will stay a really interesting topic. As I said, volatility is high, and with high volatility, the potential output is unpredictable. Thank you very much.
Thanks, Michael, and thanks to all of our speakers for your contributions today. We have now reached the end of the presentations. This is to open the floor to everybody on this webinar to ask his or her questions. Please type them into the chat function. You can see it at the bottom right hand of this screen. During the presentations, we have already received a number of questions, and I'd be happy to read out the first, which goes to Markus Klug. And the question was, do you think the current vagueness when it comes to target setting is an early stage phenomenon, eventually overcome, or is it rather a long-term way out strategy for many market participants?
Well, I'm not sure whether I understand the question correctly, but I assume the question relates to the fact that a lot of data is still missing or not complete or not comprehensive enough. That's obviously a journey we are embarking on. We feel that we have enough information to set such a target, while at the same time knowing that in some of the asset classes, the information is not readily available today, but will become available over time. Within the time frame, we're trying to achieve our target. Therefore, the target is set ambitiously, knowing that data nowadays or today is not complete, and there will be a lot of developments going forward, helping us to achieve more or get more comprehensive data in each and every asset class to achieve that. And obviously, we're also working with asset managers in those asset classes to make sure that we push them to produce that type of data going forward. And regulations, especially the disclosure directive and hopefully the level 2 part of it will help pushing the industry to gather and disclose more of that data. Nevertheless, there needs to be more assessment scientifically also, especially when it comes to scope-free CO2 data. I hope that answers it. I'm not sure. Huh?
I think so, yeah. Maybe a follow-on question going towards a similar direction to Emmanuel Salinger. A participant wanted to know, do you see the chance for instance, compliance applications for the financial sector being developed in cooperation with law and policymakers? So to close the gap between the supervisor and the subjects to supervision.
Yeah, I think that there are quite a lot of these activities going on now worldwide. I mean, some of them within Europe, within central banks and other monitoring agencies. And also globally, we've seen this a lot at the OECD level, commissions on these models where basically it's, as we've seen before, and many of you said before, well, it's getting much more complex than it was before. So in some ways, it's bringing people together to try to find ways of doing these regulations and laws together together with the upcoming AI systems out there. So especially on OECD commissions on AI, you see this often in central banks, you see this often. So I think it's a great chance for us actually to understand all of this. And I think it's a fascinating topic because it brings together the people who are doing the AI systems and the people who are developing the regulations to find a sane version of this together. That would be the short answer.
Thanks, yes. Next questions that we received from David Reutner towards Niklas Schmidt. The DeFi concept sounds cool, but is Ethereum the right blockchain as it's still proof of work, so quite energy consuming? and rather slow. And with mining and gas fees, you don't know whom you finance. And there is a second part to this question. How will these DeFi investments be regulated regarding especially capital gains tax and income tax?
Super. Yeah. Thank you very much for these two questions. So the first one is about the underlying infrastructure that is being used for smart contracts in the DeFi area. And basically, you might have heard of Ethereum, which is sort of the de facto standard, the largest smart contract platform out there. And the majority of all DeFi applications is running on this platform. There are, however, more and more interesting platforms. I mean, everything started, and this is called alternative DeFi or alt DeFi, some people call it. There are some platforms, for example, there's Binance Smart Chain, there's Avalanche, there's Polkadot with Moonbeam. So lots and lots of new types of infrastructure. And all of them are interesting, more modern, faster, cheaper, offer a lot of sort of additional benefits. Sometimes you can just copy paste your smart contract code from the Ethereum virtual machine and use it on a one-to-one basis on these other blockchains. However, Ethereum still has one vast sort of advantage. This is called the network effect. You will have heard of network effects. It is always good to sort of be on the same social media platform and not to use some strange obscure one, because all your friends will be on the most well-known platform. And the problem with DeFi, or actually it's not a problem, it's a huge thing, is this money Lego aspect, this aspect of composability. So you can put together all sorts of DeFi apps and run them in sequence. Yeah. So in the normal world, you cannot take your insurance contract. You have some sort of life insurance contract. You cannot easily take this as a basis to get a loan. Sort of use it as security to get a loan, and this loan you then used to buy investment funds, which you pledge to buy a house. Yeah. So all of these transactions are very cumbersome. You can't do them. You have to have many meetings with many bankers. And with DeFi, you can seamlessly put all of this together into one overall sequence. And the network effect here means basically that everything that is happening on Ethereum can be linked together. So if you're on this tiny island, Binance Smart Chain, for example, I mean, it's not tiny, but compared with Ethereum, it's tiny, then you don't have the full gamut, the full range of DeFi apps. And I think that it is a kind of battle going on. So Ethereum is trying to modernize, to ramp up its infrastructure. On the other hand, you have these new contenders who are trying to gain market share. But they're battling against the network effects that Ethereum still has. So that was the first question. The second question is regulation. Of course, this is a topic which is very dear to my heart since I'm a lawyer and not a tech guy. And the question here is, I mean, all of this is happening in the area of smart contracts or computer programs. How will this be affected by regulation? Does the regulator have any chance to regulate this? And if you remember what I spoke about, so you have banks, insurance companies, you have funds, you have all sorts of synthetic products being offered. In the normal world of centralized finance, of CeFi, you need a ton of permissions and whatever kind of there are all sorts of things that you have to fulfill, all sorts of requirements. And there was recently a report by something called the World Economic Forum. They produced 40 pages, and you can condense these 40 pages to one sentence. There are nearly no regulatory touch points. Yeah? So basically, the regulator does not have anybody whom he can sort of address. Yeah? Very often, these DeFi projects are carried out, are being developed by sort of people who are well known, who give YouTube videos, video interviews, to explain how their project is going to move along and so on. But there are projects out there where the developers are anonymous, where you don't really know who is developing this project, and actually you don't need to know that. And here for the regulator to sort of catch a certain person and threaten that person will not be possible. And then even if you got hold of the guy who sort of set up this or that DeFi protocol, what can he do? This is unstoppable code. So basically the computer program has been started, and if you don't have any admin keys, then he cannot stop the program. It's just it's bound to sort of continue into eternity. Yeah. So you cannot really you don't have a lot of leverage against sort of the developers or sort of, yeah. Of course, you can take down websites, super easy. But remember, there are two things. One is the front end, which is the website, and the other thing is the back end, which is the computer program, the smart contract running in an unstoppable manner on a blockchain. As I said, normally Ethereum. So if you take down the website, it just takes basically an hour until somebody will have duplicated the website and we'll put it up on a different server, on a different host. So yeah, it's very hard. There are some things that regulator will probably be doing, and very often it will be the on and off ramps, and I don't know what. But from a banking and insurance regulatory perspective and so on, I think this is going to be quite a tough challenge for regulators. So time is out, I guess, correct?
Yes, but please stay on stage. We have two more questions towards your end. But first, another question to Florian Wimmer that goes in a similar direction. Namely, will tax authorities, in your view, go rather after the retail consumer using those opportunities occasionally, or tackle the big institutions active in this field?
So here we are again at a technological difference, going after the institutions and, for example, having them withhold the capital gains tax on possible profits is just not possible in the space, as there is just a lack of information. We're taking exchange or brokerage 1 or A and brokerage B. So I can actually now go to brokerage 1 and buy my Bitcoin and send them directly to exchange B, who might not be regulated in the EU, but is regulated in Hong Kong or Singapore or wherever. Exchange it there and then send funds or coins or tokens directly back to the exchange regulated in Austria. They do not know what my acquisition date is on those assets, because that is not information that is transferred on the blockchain. So it's impossible for them to calculate my gains. So the regulator actually has to target the user himself. And this is also something that might come in place when you're trying to cash out again into fiat currency on your banking account, right? AML rules are really, really strict. So you actually need to provide a proof of origin, some kind of the flow of your assets, which then again is in the responsibility of the individual investor. So this is actually the only target that they can go to.
Right. Yes. Thank you. And this is also what we see in our sort of advisory practice. People having obtained huge wins via whatever means and not being able to actually cash them out. So that remains to be seen where we will now end up with that in the future. But one more question to you, Nikki. More towards the technical side of things, I believe. Stephanie Hemmetsberger is asking, what is your personal opinion to Solana? Is it another hype like it was with Dogecoin? And will there be some regulation in the future to prevent those hypes from distorting prices?
Thank you very much for this question. You show a bit of interest in the world of crypto, and you have come across interesting assets here. I mean, think of this. Yeah, you have this crypto market with huge market capitalizations, and then somebody comes along. He's called Elon Musk, and he says that he's really surprised, and it is terrible. He just found out that Bitcoin uses a hell of a lot of electricity, and then suddenly you have a crash in the market and values go down. I mean, this shows that we have a lot of what is called market manipulation in this area of crypto. So lots of things happening here, which would not normally happen in the world of stock exchanges and in the traditional world. So, I mean, I'm not saying that this was market manipulation, but I'm saying that this is an interesting instance where somebody just posted a tweet, and this led basically an entire market to collapse. Yeah? And we have seen, on the other hand, also tweets by Mr. Musk where Dogecoin suddenly exploded in price. So I think that this shows that in a certain sense the crypto markets are still quite immature, and that there is definitely a bit of regulation that can improve things. Yeah. You're also asking. So Dogecoin is definitely a hype. It's what is called a shitcoin, if I may say so. It has no purpose. It's just an object of circulation, and it has gone up and it will go down. So you cannot compare it with other projects like Solana, which is an intensely research-driven project with incredible incredible brains behind it, and sort of lots of breakthroughs in technology. I think it's very complicated for people who are not involved enough in this world of crypto to really be able to separate the wheat and the chaff, to really understand which projects are worthwhile, which projects have real value, and which projects are just the product of some scam artist or some buccaneers who want to get rich quick. So hopefully that answers your question.
Thanks, Niklas. I believe you have time for one final question, and that goes to Richard Clegg. Different direction now. How will more venture capital, as you described, versus private equity impact doing business in Central and Eastern Europe?
Yeah, it's. I mean, the sort of private equity has been very interesting. Obviously, after the changes, the first wave of the sort of private equity was the sort of privatization, so very sort of traditional industry, sort of pharmaceutical, telecom. I think we saw probably 4 or 5 years ago now the big global private equities almost pull out of Central Europe and close some of their local teams, focus on Paris, Germany, with a big EU fund. And that, I think, we saw lower private equity activity in the last 4 or 5 years. The venture capital has really grown because the sort of European Investment Fund took the project 2 or 3 years ago to really invest into sort of startup funds, pure venture capital, mezzanine, other. And so we now see lots of those funds in sort of various countries coming to their second, third fund, and the companies which they made the first investments in coming to a proper Series A, Series B. And as they've grown, they've got the attraction of the US venture capital. Differences between the two, obviously, means so private equity, I think, generally is looking to take sort of control over the business and to have a real management input. Venture capital very much focused upon valuation rather than day-to-day management, and so it's quite a different sort of transaction structure. And also, just from a legal perspective, within Central Eastern Europe, lots of the local laws don't necessarily translate particularly well into the venture capital concept. So, as these issues come before the court, when it comes to drags and tags and things like that, we're seeing some challenges from a local jurisdiction level in actually implementing the US concepts. But I mean, we see the US investment sort of particularly as very positive for various reasons. One is that then you're giving the Eastern European sort of companies access to the US market. So it's not just about sort of financial investment. It's about giving those companies access to the global market, which I think without venture capital, Eastern European companies would generally find very, very sort of difficult to do. So our experience is that once a company's got the first round of proper venture capital, you then see the increase of growth very, very quickly. And then these sort of series rounds as a follow on. Thank you.
Thank you, Richard. And thank you to all of our speakers. I believe we've seen today that it's safe to say that the amount of data is increasing daily. It becomes difficult to keep up with new developments, and especially to seek out those indicators that might trigger markets to skies or into a nosedive. The use of technology to process data will allow investors to have the best of both worlds, probably making use of computer ability to crunch the numbers as well as the human insight and experience. I believe it might also be safe to say that the future of investments seems to be a synergy between the human expert knowledge and AI-based decision-making tools. In that sense, let me once again say a big thank you to all of our speakers and participants for sharing your know-how and contributing to the Wolf Theiss, the future of series. If you're hungry for more insight into what the future might look like, please stay tuned and register for our next event, the future of real estate and infrastructure, taking place on the 30th of September. In that sense, many thanks to all and have a great day.